I wasn't the brightest kid in school, and apparently, depending on if it's like a leap year or something, I think there are 365 days in a year. But I just read something about the Earth is actually spinning faster on its axis now. It's messing up like the time continuum. But that's for another podcast, I think. I mentioned that because typically in 365 days, things are pretty mundane. No, not today on May 31st, people, because I'm telling you why. On today's market call, by the way, today's market call brought to you by FactSet, financial data and analytics powered by Tomorrow. Not only is Dan Nathan here, but Danny Moses is here, and Carter Braxton frickin' Worth is here from Worth Charting. If we had EY from SoFi with her cat out in parts unknown, we'd have a friggin' full house. I'd play that hand. How are you, Dan?
I'm doing well, Guy. How you doing, man? You're all knotted up today. You've had a heck of a couple days here. You're playing hurt a little bit. We can hear it in your sniffles. Last night on Fast Money, Guy was not on the screen. He was remote, and all of a sudden we'd hear somebody blowing their nose and this and that or whatever. But you seem a little bit better, and you got a big smile on your face.
I'm fine.
You're fine.
I'm trying to figure out, talking heads, how did I get here? I'm walking down the street. Hey, Danny, come on up. Glad to be here with you, gentlemen.
Yeah, well, this is kind of fun. I mean, listen, guys, like put some comments in the comment section here. Anytime Danny is at the Risk Reversal Media Global Headquarters, I mean, we want him on the market call, don't we there, Guy Adami?
Absolutely. Are you kidding me?
Yeah.
Absolutely. And it's amazing to me. I think, time moves forward for most people, but in Danny Moses's case, time sort of goes backwards because if I'm not mistaken, Danny, you get better looking every freaking time I see you.
All right, let's just do it right out of the gate. Let's bring Carter in here. Let's have a major bro down because there he is.
Wow.
These guys, Danny
This
and
is
Carter go back.
This is the over 50 crowd. This is AARP. Is that what this is? What the hell?
All right. Well, I mean, listen, let's do, speaking of over 50, and he's just a few years older, over 50, but Doug Cass often hits Guy and myself before the show. And he says, here's a good one. And he had an email to us. He said, the .com mania had only one dot, but the AI mania has two dots. Yep. AI, ergo, is very dotty. I like that here because, listen, guys, I almost lost my shit on Fast Money.
Whoa, almost?
Well, yeah. Well, oh, really?
I think it was pretty.
I lost my shit a little bit. And because we had two conversations, okay? We had a conversation that we led off about AI and like how it just infused itself in the market cap and the valuations of the biggest companies in the market. And we were talking about also how just small caps, energy, staples. I mean, the list, like the list goes, resources, the list goes on and on and on, that we're acting like dog shit. Okay. And then you saw what's going on in China and you saw the data there, right? So like we had that conversation. Then we had a totally separate other conversation about the banks. Okay. And that felt like a conversation from probably March or April or May of 2008. And the AI conversation felt like a conversation that you might have had in December of 1999 or January or February of 2000. And we did that all in one show. So talk to me, Guy. You were on the set here last night. And I mean, like, didn't that feel like kind of creepy?
Yeah, it's interesting because I understand what's going on. I think we all do in terms of the mania around AI and everything surrounding it and all these stocks that seem to be caught up in the wake of it. Obviously, we'll talk about some of the names today, but below the surface, things are concerning. And you're right to point out energy stocks. OIH is probably at its lowest level in 4 or 5 months. Materials are getting blasted. Gold's hanging in there, but I would submit, and Danny would probably agree, I don't think gold is a commodity in the true sense of the word. There's really no end use. But I'll say this, the thing that sort of sticks out to me like a sore thumb, Dan, is how poorly the banks continue to trade. I mean, it's bounced a little, the KRE and the BKX, but not nearly commensurate with the broader market. So people can get all excited all they want about this new technology and the fact that AI is going to take us to the new millennium. It's going to drive the broader market. But banks are telling a much different story.
Yeah, banks are, keeping money in reserve. They see quantitative tightening still happening. The risk reward for them to go out and lend on these margins doesn't make a lot of sense. I think they'll be focused on their current customer base and what they need to refi out there, right, to protect their own investments and so forth. And we're already seeing it. We talked about it last week. Banks are offloading to non-banks now some of their assets and try to get refinancing because they can't get out there. Today, there's an article in the Wall Street Journal how, loan demand cannot meet the supply at this moment because there's just not enough supply out there. So a lot of zombie companies out there. And just to go back to your point on this AI trade, listen, I have no problem with people going and buying a theme or a thesis and, and expressing it in some of these names at all. I mean, but I feel bad for the people that pile in, that believe that they don't care about price, which was the title of our show last week on the tape. Price the wayside, just to be a part of something.
Yeah.
And that's the problem here. And I think Dan's, not anger, but Dan's emotion is really tied to help people. I really believe that. And it's frustrating because between the four of us, we've seen 150 cycles. And so we've seen the game before, and it always goes longer and farther than you think it's going to go, both to the upside. And I will say this on the downside, when things do get hairy, and I believe Guy just described a very hairy situation that I believe that we're actually in, this AI, things would feel kind of a lot worse. The same can be said to this. It's important to know. Everyone picks their spots on the downside when they're going to buy. They don't, when the stocks actually get there, they don't do it.
Right.
That's as bad a behavior as chasing at the top is not buying at the bottom.
No doubt.
We'll do that someday.
But so Carter, and here's one for you. Okay. And the last point that I had last night in this block that we were talking about this stuff. And, I just said that, listen, the thing for me, and Danny, you make this point on the tape all the time, is like, we're trying to use our experience. We make mistakes like everybody else in the markets. Okay. But we try to do it rules-based, that sort of thing. Right. And try to take the emotion, let's say, out of the decision-making process. But obviously markets are very emotional. And so the last point I made, Carter, is like why I'm so emphatic up here is like, if you're buying Nvidia after it just rallied literally like $400 billion in market cap, okay, because this thing that we all know, you're probably doing it incorrectly. And just like things overshoot to the upside, they tend to do it to the downside also. And we've seen that. I listed again and again examples of stocks. Meta was a great example in late 21. Tesla was a great example in late 21. Those stocks lost 75% of their market value. So Carter, talk to me about the phenomenon of overshooting on the one side, but also doing it on the other side.
Sure. Well, I mean, to some extent, Nvidia is just the poster child, right, for what is really in many ways a fear-based approach to markets, which is to say the two most offensive things you can do, of course, is go into true safety staples, consumer names, or try to hide in idiosyncratic growth, i.e., let's take Microsoft, a mature business that has reliable growth that is less dependent on the business cycle. And if indeed there is a contraction, it doesn't contract the way Ford Motor or Alcoa does. But I think the issue about overshooting, to your point, that the irony is that we were coming into this week and it was 100% guaranteed, according to every observer, that we would go higher because the debt deal was resolved. And now that's all you needed. You had this AI run. And in fact, of course, they rang a bell of sorts. Nvidia and the debt deal have nothing at this point left to offer. And I would just point out in terms of the ongoing discussion of lack of breadth, there are weak ways to measure that. And this is very important. If you talk about new highs or new lows, that's arbitrary. For instance, Netflix could be making a new 52-week high, but it's still 50% off its all-time high. Right? Or, for instance, a number of stocks above or below a moving average. If a moving average is dead flat, if you have a 2% up day, a lot of stocks get above that moving average and change the statistics, right? Advanced decline. So the real way to consider is the move since the October low, broad or not. It's simply this. If there are 3,000 stocks in the Russell 3000, there are a few less because of basically buyouts and so forth, but all constituents since the low, global low in equities, from the DAX, the CAC 40 to every index, how many of those constituents are actually up if that's the low? Here's the answer. 50% of all stocks in the index are actually down from their October 13th low. So the index itself is up some 13%. But half the stocks in that index, this is not an arbitrary new high, new low, 52-week high, 52-week low, above or below moving average. It's just taking the reference point that everyone is citing as the low for the market. Half the stocks are actually down. And here's the worst part. The index is up 13%. The performance, median performance of all constituents is up 1 basis point. It's almost, if it weren't so sad, it'd be laughable.
It's interesting. If I were Gomez Adams right now, I'd be kissing Carter's arm because when he said coqueron, he did it in such a beautiful French accent. But I digress, as I typically do. Little curveball for you, Carter Worth. Nvidia, three huge volume days in a row, couple of gaps to the upside. Is there a potential for the much feared island reversal to the downside? Because as we're sitting here today, that stock has had a pretty meaningful move to the downside, down some 4.5%. And the volume that we traded over the last couple of days was not short covering. I mean, there were no meaningful shorts in the name. That's just people piling in. What are your thoughts on that? Then Dan's going to look at the S&P.
Right. So there are two types of gaps, or several types, but there are exhaustion gaps and there are also breakaway gaps. And there's a big debate whether this is a breakaway gap in Nvidia's case, or it's an exhaustion gap, and Nvidia having moved up and up and up, and then this euphoric yet further piece of strength, news related, and there's almost nothing left. It's that child doing the chin-ups, and how many can he do? He's slipping from the bar here. I would just read something I found astounding, and I'll give you just 2 seconds. This came over my tape. This is a direct quote. Nvidia's massive run in the market is most likely reflected by the future growth of AI with a very lofty PE and price to sales at the moment, but that is the market pricing in that growth. Ready for this? Many naysayers will come out and say, oh, such a high PE, I wouldn't buy here. To those people, I would say you should probably get a job in a different industry because you don't know what you are talking about or doing. What an arrogant thing for anybody to say.
Yeah, what a mofo, as I might say here. I mean, listen,
really?
Let me just say this, Carter. Okay, that $250 billion rally in a week in one stock, and that's not accounting for the other stocks that it pulled up with it, okay, was based on a $4 billion revenue beat for the current quarter. That might incorporate double or triple ordering. It might incorporate a lot of ordering by companies who feel the need to make those orders because all their competitors are doing the same thing. Remember, all of these companies have spent the last 6 to 9 months cutting costs, cutting jobs. These chips are expensive. The supercomputers that they go into are expensive. The cost of compute to run them is expensive. If you cannot commercialize this, if you cannot actually make some sort of revenue off it that ultimately will turn into earnings, and that doesn't happen soon, and we have a difficult economy, this is what gets cut next. So if you're telling me hundreds of billions of dollars in a week of market cap have been created because a $4 billion revenue beat on a quarter in one company, that's the dumbest fucking thing I've ever heard in my life. Okay, moving on, let's look at the S&P 500 because this is something that's also got me a bit excited. Okay, so we were talking last night on Fast Money again about the market dragging up. Carter, your data about the Russell 3000 is fascinating, especially the data about where most of the stocks are relative to their October lows and how much the ones that are up, how much they're up. Look at this thing, man. If you're trying to make an argument that this is like a broad-based rally, it's just not. The S&P has been in this range, right, for 2 months or so here. It stuck is kind of head above the sand a little bit. It's back here a little bit. I get it. If we're going to break out, we're going to go to that August high. It's 43.35, where the hell it is here. Talk to us about what you're thinking, because Guy just asked you about the gap in the chart of Nvidia, but you've often said this for years and years. I mean, when you look at a major indice and you look at gaps, the gaps are meant to be filled, and you have some data on that.
Sure. So actually, the strength earlier in the week filled an unfilled gap. When you see that August peak, which is on this chart, you actually see your lower of the 2 red lines, the parallel lines you've drawn. The market gapped down on August 22nd. It was a down 3% day that day. And that was already a 2-3 day sell-off that ended up being a 20% decline, right? From the August 22nd peak to the October 13th low. Yesterday's strength, we filled that gap. And that is the sole unfilled down gap in the history of the S&P going back to 1928. There are none above, but there are gaps unfilled below. Let's look at them. So current, this is, yesterday's close or whatever it is, you see the current price 4205. So we have unfilled gaps immediately below, and those are the levels 4082, 4030, 3980, and that's respectively down 3%, 4%, 5%. We can look at it on the chart, but the point is, this schematic, there's that solid blue horizontal line was a dotted red line on the top of the chart. It was an unfilled gap, and the strength associated with Mondays or Tuesdays, of course, Monday was a holiday, opening thrust filled that gap, but we leave 3 below. Let's look at a longer term chart of this. Let's look at even longer term chart of this. What we have now, you see all of those blue lines were dotted red lines. Not to say that all gaps get filled, they do not, but somehow the notion that we're off to the races, that we're going to continue to strengthen, make new highs as the bulls would have it, and we're not going to fill those 3 unfilled gaps that are immediately below, I would say the odds of that are as close to 0 as you can get.
Here's the problem with all of this, and I totally agree with this. When you talk about Nvidia, and you look at the S&P 500, same thing. When they start to trade down, what's the buy point? It's psychological, obviously, on the way up, FOMO, missing out, but on the way down, you use valuation. I'm going to wait. I'm going to wait. I don't want to buy it here, right? Because it feeds on itself the same way the upside is the downside. The problem is when the market goes down, and I believe that it will at some point and fill those gaps, obviously, the narrative starts to come together. And what I mean by that, debt ceiling was not an issue at the end of last year. No one was even talking about it. The bank crisis wasn't an issue for 99% of people until March 6th. We get these things resolved, and you want to call them resolved. We got the bank issue resolved with less lending, and we're going to get the debt ceiling resolved with less spending. And we're going to have debt ceiling resolved with issuing more treasuries. I could go on and on. My point is that it's like an excuse to buy, an excuse. AI is an excuse to chase. Yeah. But what's the excuse to buy on the down? That's where I think this is really dangerous in terms of people that are out there that are buying the markets at these levels. You make a point, Carter. I could make a bullish comment to your point about half the Russell 3000 is down. I could say, okay, if I'm bullish, I'm going to say, well, they're going to catch up, right? They're going to catch up. But what are they catching up to? Because those are tangible companies that need capital, that trade on valuation, that aren't owned by the same people, that don't show up in the meme world. So long-winded way of saying, I agree with all this, and I think it's going to happen. I thought it would have happened already, and it hasn't. And, again, from a quality of earnings perspective, as we go into the middle of the second quarter, I think the realization will be that 220 is not going to be attainable for 2023. And we will roll forward to 2024 numbers starting with third quarter 2023. And people can put an unrealistic number and start to trade on that, and the Fed's done. So anyway, see what happens here. But at best, I think we're still range bound. And at worst, Carter, I think we do fill those gaps.
Fill those
Jacob,
gaps, right. And
sorry,
valuation is a notoriously bad timing tool. I think maybe to your point, people will try to apply that when it's down, and yet either they won't do it because they'll hold off, or they will and it won't be cheap enough, because it is invariably a situation where you always get cheaper. One thing about the bifurcation, just to your point, is, and I have clients that say, well, wait till those laggards catch up. The history of bifurcation is exactly the opposite. The hope, the thought, the conventional wisdom is that the strong are telling the truth. Microsoft has actually got an accurate read on the future. So does Nvidia, right? So does Apple, and so do the home builders. And that the weak ones, the 3Ms and the banks, they're so cheap, they stabilize, and the bifurcation gets resolved by the weak curling up and coming to life and the strong staying strong. Well, guess what? Every single time it's been resolved the opposite way. So the Nifty 50 was bifurcation, and ends up the steep ones succumb, Xerox and Polaroid and Eastman Kodak. We had it in the 07 peak as the market was making new highs in October 07, but the banks were already down 20, 30%. We had it in the .com, and we have it now. Bifurcation is almost always resolved by the weak ones actually having an accurate read of what's coming, and the strong ones simply reflecting people hiding in them. But when they stop hiding in them, the strong ones succumb.
I feel very, very bifurcated. So.
I don't even know what that means. Well, speaking of, strength, Apple making a new all-time high today. I think, from the low we saw in earlier this year, about 125. I mean, that's a pretty historic move. Stock's probably up 50%-ish.
Well, it's actually a new 52-week, but if the all-time high came in late August 2021, was just about 183, guys. So
all right, so I'm off by, but here's where I'm going with this. We're right there effectively. The potential for a double top in this is extraordinary, I would submit, given the unabated run we've had over the last 6 months. But Carter, let's take a look at the NDX, because again, this thing is telling a much different story. But people, this perceived flight to quality in a handful of names. I mean, things are getting crowded really quick, and that's a great looking chart. There's no denying. But have we sort of overshot, and what is this setting up for?
Yeah, and the way to really sort of dissect this is there's an equal weight ETF, the I guess it's QQEW, and you'll see that it doesn't look anything like this. So it's just further and further testament to one or two players pulling the team along as the team continues to basically not perform well. I would expect this to at least check back to the level from which it broke out, and if not, ultimately give back more than that.
Yeah, well, and again, this is not going to look too dissimilar. Let's pull up the SMH chart, the ETF that tracks the semiconductor index, and again, obviously, Nvidia, huge part of that. Taiwan Semi is also one of the largest components, and if you look at the SMH, it is telling that sort of story too, but it's a bit narrower, and it's a bit more sharp. Obviously, the parabolic rise. So the check back to that breakout level, Carter, makes some sense. And then to your point about bifurcation, we just want to pull up the Russell 2000 really quickly. So this is small caps. And to Danny's point about access to capital, cost of capital, a lot of these companies are unprofitable. So this is kind of in kind of telling the story in a picture, Carter, of what you just kind of laid out about some of the weaker companies kind of leading the way.
Well, that's right. Or not participating. And then again, they're perfectly valid, but I don't think it's accurate to interpret it as the opportunity that these catch up. It's almost always the opposite, that these belong here and that they're not cheap and have every possibility of getting worse, whereas the strong ones are ultimately full, rich, crowded, steep, or the word in fundamentals, expensive.
Yeah, I mean, all these charts make sense. So Carter, I talk about this on the tape all the time, and you have meetings all the time with fund managers, and I'm trying to get people to understand, and it's explained in these charts. So if you're a fund manager at a large Boston mutual fund, and you have to beat the S&P, or you're paid to beat the S&P, and then within each sector, you're overweight or underweight, they come to you and they say, all right, they see these charts, they are forced, their hands get forced again to sell the names that aren't performing. And Dan and I talked about this last week, the likes of PayPal and Square, et cetera, to go chase, because we are, almost halfway through the year here. And if you didn't do that, and you just have to do it. And June 30th, it should be quite something actually at the end of the quarter. Now that I think about it, but Carter, talk to the process, if you don't mind, just for 2 minutes about those.
Sure. And those players, and Daniel refers to Boston in particular. There's two particularly large players up there, each with over $1 trillion. There's another down in Baltimore, names everyone knows. But I'll give you an anecdote that speaks to this, having to do something. I was once presenting this probably almost 20 years ago. And I said, this stock is particularly steep. I think you should trim it. And the PM says, I can't. And I said, why not? What do you mean? Of course you can. He said, no, I can never buy it back. I said, that is the stupidest thing I've ever heard. Of course, trim it now. And if it dips, you'll buy it back. He said, no, you understand. We're full as a firm. We can only have a limit of so much that this firm can own of that stock. And it's full. So if I give this up, someone else internally, another PM will grab it. And I will be locked out of this thing forever. Now think about that. That's not money management. That's not valuation. That's not just discussing free cash flow. That's just playing chess with a benchmark. In fact, with a situation where you can't give up a stock because you'll never be able to touch it again. So finding Nvidia 10 years ago, or an ISRG, when everyone else has got a knife and a scalpel and you've got a robot in the operating room, you want to own ISRG. The point is that there are mechanical things. These people are benchmarked to an index. They are forced, the word Danny used, they are forced to do things that sometimes a practical sense they wouldn't otherwise do. They have to benchmark. They cannot let the benchmark get away from them by too much, because you lose your job.
And let me add to that. The quants know it. Quants have all this information at their fingertips. So they know how to force the chase to the up and to the down. So I'll just add that part too.
All right, Carter, you've been very generous with your time. Before you get out of here, you had a report that hit my inbox from Worth Charting this morning. And I actually, before I opened it, I was like, oh, thank goodness that Carter is going to actually reinforce something on a stock that I care about deeply. And it was Tesla. And then I got through the report and it was brilliant. And it actually, I don't know, it belies a little bit of my thought process here. Talk to us what you're seeing and the charts in Tesla right here before we let you go.
Sure. So Tesla's, try to trade this as much or as often as anybody. And there've been some good judgments and some bad ones, but take a look at this setup. Now, those are perfectly parallel mathematical lines. Yes. Look at the next chart. Look at the next chart. It's Tesla. There's a lot of symmetry, rules to symmetry, rules of ascents and descents. And we're basically approaching a level which is inherently difficult level, but we're not there yet. So let's put in some arrows to make a point. It's just exactly to the penny, to the penny, to the penny, over and over. But my hunch here is this time that rather than actually hitting its head and turning down again, that we're going to press a little higher. So next iteration, take a look at, that's a 1-year line, because that's a 4-year chart, and we've pressed above it. Let's zero in on that, and let's now put in a moving average. what you've got here is now let's just remove the trend line and just the moving average. The 150 days on the cusp of flattening. You can annotate it other ways. Next iteration. Here's a shorter term, excuse me. Now put in an annotation or two. This is what a reversal looks like. I think it has some room to run. There is overhead here, but my hunch is to be on the long side. And what I like about it day to day is its hour to hour relative strength is okay relative to things that I think are way overdone, like Nvidia.
225 is going to be your level, Dan. If we're to get there, it's probably the opportunity to, try this again on the short side. But, the first chart, I love the first chart with no lines, and then Carter brings in the chart of Tesla. It's actually brilliant because when you see it, it just makes a lot of sense. But let's see. I mean, you take that, then take the next one where the actual chart is. It's fascinating. So some might be inclined to say, you know what, this chart's going to hold up. Carter's showing you why it should break out. But in my opinion, I think the breakout's going to be somewhat short-lived, maybe 225, Dan, Nathan.
All right. I don't disagree with that. The one thing I'll tell you that makes me nervous about Tesla right here, especially, is I think the fever broke with this AI stuff. If you look at that C3 AI guy, you and I were talking about it yesterday, and the market call was up 30%. It closed up 35%. It's down about 10, 11% today. I think Nvidia, the reversal in Avago, Broadcom yesterday, and Marvel filling in that gap a little bit. I think the fever might have broken here. So I was worried, though, that Tesla is getting kind of swept up into this whole thing last week or 2 weeks ago when Elon was speaking with David Faber. He mentioned something like, we're going to have our AI moment, which made me kind of nervous a little bit, and being short the stock or long puts, that sort of thing. So, all right, Carter, we really appreciate you going over time with us here on the market call. Thanks for your fine work, bud. We appreciate you.
Okay, man. Best.
Thanks,
Bye.
bud.
To you.
Danny, thoughts on that, on the Tesla here a little bit, and just
I'm so in shock right now that you would bring up something bullish on it, and even if it's in a
no,
technical form.
you know what?
No, I'm kidding.
It's just kind of understanding what could go wrong a little bit, and it could easily. I think this last 20 points from 180 to 200 throughout this whole period where we've seen a lot of these semis being swept up. I mean, let's be very clear. One thing, Tesla is a buyer of these chips. Okay. They've been buyer of these CPU, GPU combinations. When you think about autonomy, and so much of the value of this stock of Tesla is wrapped up in their ability to get to full self-driving, which you and I think many people think is years away, but that's a big part of this story, correct?
China, whatever you want, unlimited demand, robo taxis. Yeah, if that's all it is technical nature.
How much do you rely on the charts? Okay, so it's an
when it looks like that, I ignore them.
You do?
No, I'm joking. I'm joking. No, we used to have Carter in our office, and we were short a name, and he would. I'm like, Carter, what now? Look next. No, but listen, that's an objective way to look at it. It feels like it could go higher, so it needs a reason to go down. We'll see what that may or may not be.
Well, it's been floating higher with no good reason.
I'm well aware.
Right, let's hit a couple things here, Guy. You brought up the banks earlier, and they really do act very poorly. And when you think about on a relative basis to other parts of the market that you think should be acting better, especially as we got through this debt ceiling situation, hopefully, I think part of the issue with the market today is maybe that's not a done deal. It still needs to pass the House, and Biden needs to sign that thing. So it seems to be a little bit in political purgatory, at least in the time being. And then obviously there was the regional banking thing was over. None of us believe that. Talk to us a little bit about the banks. XLF doesn't look particularly great. Bank America, one of the worst acting stocks in the entire market, in my opinion. Thoughts there, and then Danny, I'd love to get your fundamental take on them.
There's no bounce. I mean, we talked about it yesterday. I mean, the BKX doesn't bounce. The carry has bounced a little bit, but not nearly commensurate with the broader market move, and it's got to be concerning. They're clearly not on the front burner in terms of network coverage and people talking about them sort of out there in the Twitter sphere and stuff, but doesn't mean things have been rectified or fixed. The bigger banks are getting bigger. Doesn't mean they're getting better, though. And the landscape is such. I mean, Danny can speak to this, and we talked about it on the tape last week. Very quietly, 2s10s has gone out to about 75, 80 basis points. Inversion having traded down, I think, below 50 basis points. Nobody's talking about that either. So I think, I don't know who's going to be next, but for me, there's no compelling reason to be trying to cherry pick banks at this point. And I know we had one of the analysts on yesterday that said contra. I just don't think now's the time.
So mortgages have been selling off. Treasuries have been selling off. Rates moving higher on both. Obviously, they move in inverse direction. With that, to Dan's point he made a few weeks ago, the marks are coming back on these books for these banks that haven't dealt with it yet. And the irony is that PacWest didn't sell securities to Kennedy Wilson last week. They sold construction loans. The point is that here, beyond that, all this, and I said it was a beauty pageant for the banks, these ones that come up for sale, and the banks, big banks, all get a look at them. They don't forget what they saw, right? It wasn't pretty. And what they saw was not the securities portfolio. They saw the loan portfolio. And I think there's a big difference in that. Let me just highlight something else which came out today. So the Federal Housing Administration, the FHA, which really caters to low-end borrowers, right? So you got your Fannie and Freddie and Ginnie Mae. Ginnie Mae is kind of where you find the FHA loans. They're modifying right now for low-end borrowers who can't make payments, right? Because they can't refinance because it goes to a higher rate. So they're now being a middleman and paying a part of their monthly payments. It's on the back pages today of the Journal. It's a proposed rule that go in effect in the 30 days. That's happening now. I mean, so we talk about real economy stuff that's occurring. We talk about banks in general. Banks are pulling back. We've had some M&A. We've had some decent M&A, right, recently. But now I think people are starting to look ahead and project what these numbers are going to look like for the banks. And so Jamie Dimon's telling you, quantitative tightening is still not being paid attention to. It's a killer for all these banks.
The other thing, Guy, to your point about the large cap names that again have supposedly been the beneficiary, right, from the deposit outflows, right, from some of the regionals. When you think about it, like, if we are literally in the second or third inning of the regional banking sort of crisis, especially with rates going higher and this, but like basically that mark-to-market issue becomes more acute, and there is a reason for some of these regionals to lose deposits. Because again, maybe the losses they suffer, we haven't even seen bankruptcies, on the commercial real estate side, which could put big holes. Okay. Forget the mark to market, held to maturity sort of stuff. That's another part of this equation. Then all of a sudden, these major banks are going to have to up the ante as it relates to FDIC insurance, right? And so regulatory costs are going to go up. I mean, the list goes on and on. So that's why I think the banks act the way they do. Guy, here's one though, and you mentioned the XLE and the OIH. The OIH is trading at 5 or 6 month lows here. So that's oil services ETF. Let's pull up crude for a second here. And we've seen a lot of data about China. There was weak data today. Is this crude move, the 50-day is up there at 75. The 200-day is up there at 80. It's below this $70 level. It's down 1% today. And you just see that. We just drew a simple line there. It's been down below that a couple times over the last few months. It feels a little different now. When you look at, let's pull up the OIH for a second here, the services, right? And then if you want to look at the large integrateds in the XLE, the space feels really heavy. It was and this is really goes back to this AI and the tech and the concentration. This was one of the only things working in 2022, and investors piled into it. And we've been talking about our main man, John Butters. He told us this in his Earnings Insight blog many times late last year, and we recited it on Market Call, okay, that the contribution of energy earnings in the S&P 500 was going to trail off in Q2. And you better have some other areas pick it up, because without energy earnings contribution last year, it would have been a bloodbath, okay, as far as S&P earnings. And that's why your 220 number, Danny, this year that you are suspect of, I agree with you. And then if you look at the out year, 2024, I think consensus is for high single digits growth. Okay. So the market is just massively overpriced. If you look at the 10-year average of the S&P 500, the PE multiple, okay, on a forward basis, this is per FactSet, is 17.3%. We're basically trading at 17.8% right now. Okay. Or 17 times, excuse me. Thank you, Danny.
You got
17. So a lot of FactSet data there. But Guy, talk to me about energy, because this one feels like it's kind of going the way of the dodo here.
Listen, so the wild card here is an OPEC meeting where I think they're going to try to basically do everything they can to get the price back higher. I'm not sure that it matters at this point, but I'll say a couple things. And you pointed this out. When the Chevron, when Chevron announced that $75 billion buyback, that marked the top in a lot of things. And then it culminated with ExxonMobil on that Friday a few weeks ago, announcing their earnings when the stock traded up to, I think, 121, made an all-time high. And you actually outlined a short position in that stock. So energy stocks don't trade particularly well. And I do think part of the story here is people getting out of energy, getting into these high-flying technology, one. Number two, I think people are concerned about this China situation and a global slowdown. And then obviously the underlying commodity isn't helping. So you got three things working against it. I'm going to hold out hope for this energy trade, but it certainly looks like a loser right now.
Yeah. Okay. Well, listen, that was a lot of fun. We covered a lot of ground here. We had two of our best friends, not only in the markets, but in life, join us
Aw.
today, Guy, on the market.
I feel
Call.
that way.
Can I
feel
make a
that
comment on the way out? So
Of course,
Yeah,
dude.
of course you can. It's your
So,
show.
one of my really, really close friends who watches Dan all the time, watches you guys, obviously, and he listens to the show. And he says, "Does Dan blame you for being so bearish?" I go, "What do you mean?" He goes, "I mean, he spent a solid 2.5 years with you now. Do you take any blame?" I go, "Blame, credit? What do you want to say?" So in here, I turned to Dan right before we came in. I go, "Dan, do you think?" He goes, "You know what? Yeah, I do think so. All the vitriol and stuff, got to let the anger, let it go a little bit."
You know what's
sometimes.
really funny?
Yeah.
So last night, in our break, and Guy was remote, but it was Tim and Melissa Lee and myself and during Fast Money, and Melissa just said, "I'm getting lit up like a Christmas tree," and like about you. And she goes at the very end, she's like, Dan, he really is like a happy guy. This in life, I really am. When it comes to markets, though, we talk about this a lot, Guy, and every trading desk I've ever been on, starting in 1997, it's just a lot of emotion. You know what I'm saying? And
Yeah.
so hopefully you have a process, you have risk management, you have lots of different inputs that help inform smart decision making process. But there's a lot of emotion in this thing. And just look at all the other participants. Look at the analysts on TV who come on. Look at people in boardrooms, investment committees, executives. Look at like there's emotion all over the place. So to me, that's what I love about the markets. That's why I'll never do anything else as a profession, because it changes every day. The people change, the stories change, and emotion's a big part of it, right, Guy?
Absolutely. Listen, and here's an asshole comment from Jay Rice. So maybe Jacob can pull it up. It's almost like clockwork. 4 bears push their book and all indices rally right at 1 p.m. Okay, so this goes back to what Danny started the show with. We're trying to help people. We're not trying to, it's, let me tell you, I'm going to be honest with you. It's really fucking easy to go on TV every day and have the pom-poms out and everything's okay. And then the market gets basically fricasseed and there's no ramifications because everybody's in the same boat. It's the people that are trying to help. I think that people are trying to do the hard work out there, not the easy work. It's really easy to blow hot and cold with the tide. It's really hard to stay with your thought process and to try to help people along the way. Because I got to tell you something, having lived through 08 and 09, doing Fast Money at that time, and hearing sort of the feedback we got from people that said we didn't warn them, I vowed never to make that mistake again. And I'm not suggesting we're at 08, 09, but there are certainly things out there that are concerning, Dan Nathan.
All right. Well, listen, we did it. That was
You
fun.
like that, by the way?
When we get off script. Not that we ever have a script. We don't have a script. We just have some charts that are going to help.
People will come, Jay. People will come, Jay.
All right. Danny Moses in the house. Stick around. Guy and I are going to be back tomorrow. Liz Young, EY from SoFi, will be in the studio with us. Danny, Guy, and myself are going to record a fabulous edition of On the Tape. That's going to be tomorrow morning. And we also have a great strategist from JP Morgan that Danny and I are going to be speaking to, Gabriela Santos. And so we're going to have a big macro discussion with her. So that drops Friday mornings in your favorite podcast store.
You know what? I just decided what my favorite podcast store is. I'm not going to give it away.
Stitcher.
And it is Stitcher. But that's it for Market Call. I want to thank Danny Moses, who was just wandering around Lower Manhattan, just decided to pop up.
Talking heads. How did I get
craziest thing? Obviously, the great Carter Braxton Worth of Worth Charting. I want to thank FactSet, financial data and analytics powered by Tomorrow. I want to thank our audience. Good and bad is always appreciated. We will see you tomorrow, 1 p.m. Eastern time.
Thanks, Guy. Thanks, Danny. Thanks, Carter. Thanks, everyone.